I'm David Sudeck. I'm with JMBM Global Hospitality Group. We're here at the 2015 Meet the Money Conference, the 25th annual Meet the Money Conference. I'm here with Elizabeth Braman, Chief Production Officer at Realty Mogul. Welcome.
Thank you.
So, first of all, how have you been enjoying the conference? And I assume this is your first conference?
It is my first conference. It's fantastic. It's really nice to see all the hospitality stakeholders all getting together and talking about capital in the marketplace.
And your focus, Realty Mogul's focus, is hospitality and non-hospitality, right?
Yes, we do all asset classes that are cash flowing real estate across the country.
So no new construction?
No ground up construction, no development deals. We're really focused on deals with a value add component, but definitely cash flowing at some time in the near future.
Got it. So what is your walk us through a typical deal, a case study of sorts?
Case study of sorts, okay. It could probably is going to be in a primary or secondary market somewhere in the United States that has still good cap rates. So we're really not in a low cap rate environment. We're probably looking at something at a 7% or higher, which in hospitality is still easily achievable in many areas of the country. We're looking at something that has a value add component, so something where there's still some work to be done. So we usually don't come into a transaction that's fully stabilized and as a buy and hold. We're really looking at something where there's something somewhat of a pop for our investors at some point in the transaction, because our crowd, our network of 16,000 plus accredited investors that are investing in real estate are really looking for something where they have an alternative to a lot of the REITs out there. They're looking for something where they can get both cash flow and a little bit more yield than they can find elsewhere.
Got it. What's the structure of their investment typically?
So they're investing anywhere from $10,000 up into a LLC, and we combine all of those investors into as LP into an LLC that we are the managing partner, and then we invest as one, almost like we're acting as a high net worth investor on behalf of our investors, and are coming into a transaction either as the total capital or as always as the LP to our sponsors as the GP. What that provides to them is a really elegant solution for raising capital. We get one K1, one distribution, and one quarterly report, and then we take care of, using our technology, all of our investors on our side of the transaction.
Interesting. That's fascinating. And who came up with this concept? And tell me when you opened for business. What was the day one? Day one
was about 2 years ago. Okay. Our CEO, Jillian Hellman, was really the brain trust behind this concept of crowdfunding for real estate. She saw an opportunity in the Jobs Act to raise capital for real estate investments. Interestingly enough, we're not really doing what was generally conceived to be crowdfunding. We don't raise capital from unaccredited investors, and we're not doing a ton of general solicitations, although our first general solicitation was, our 506C was for a hotel. We raised capital.
That was the Hard Rock.
That was the Hard Rock. We kind of
nice high-profile place to start.
It was a very high-profile place to start, and it was great from the perspective. It was a huge marketing blitz. We got 110 million unique impressions online for that opportunity, and we're in everything from The Guardian to the Wall Street Journal to Bloomberg. So got tremendous amount of press, and it was a great opportunity there to show how crowdfunding can actually provide value to hospitality owners, in that that partnership allowed us to give to our investors the ability to invest as an owner in an operating hotel. And by doing so, we were able to give them some perks in terms of discounts to the hotel and to the restaurant.
So that became insiders in the Hard Rock
They became
Hotel.
Insiders, and they get to have an owner's card and tell everyone that they own a piece of the Hard Rock. But that Jobs Act allowed us to launch our company, and in the last 2 years, we've gone out and raised over $40 million in equity capital for smaller transactions, $1 to $3 million check size, across the country, using our network of accredited investors in cash flowing real estate. So
are you planning to keep it on the smaller side, the 1 to 3 million, or do you want to grow your investments?
we will be growing our investments in time. Our last 3 investments have all been in the 3 million plus range. So we're definitely looking to write bigger checks. We'll go up to 90% of the equity on a given transaction, which now we've just launched our commercial lending division, allows us to get up to 97% of the capital stack. So on a $10 million transaction, we will provide, let's say, $7 million as a first trust deed with a conventional lending source, either a bridge or CMBS debt at market terms, and then we'll raise up to 90% of the equity on the transaction. So if you had a $10 million transaction, $7 million might be debt, $2.7 million of that would be the equity, and the sponsor would come in with $300,000 to round it out. So where we are a little unique in the marketplace is our ability to be a full cap stack provider to our sponsors/borrowers.
And what's the source, without giving it away, anything confidential, what's the source of the debt portion? Is that also crowdfunding?
That's primarily institutions. We found that the institutions have a greater appetite for low yielding, longer term investments. So we have institutional capital partners on the bridge, and on the CMBS side of things. We could offer up to the crowd. They might be more interested if we added some mezz to the transaction, depending on the term.
It's slightly lower yield, but slightly less in the risk capital stack.
Right. It's like we can do preferred equity. We can do JV equity as well, which is all crowd sourced. So yeah, it's nice.
What's been the target internal rate of return, or I don't know how you're measuring the investment
Really
criteria?
depends on the asset class and location. So it's all risk-adjusted return. So if you had something that was in a more core market, we've done multifamily and let's say a Class A multi in a Tier 2 market. We have had stuff that's as low as a 13 IRR with an 8% average cash on cash. If you're looking at your hospitality deals and it's in a more secondary market, you might see something north of 20 on the IRR and north of 10 on the cash on average for a 5-year hold.
Got it. In terms of investments, are they your new investments coming from mostly repeat recurring investment by existing, or are you getting a lot of sign up of new investors?
We're getting a lot of both. Most of our sponsors that we've done a transaction with are coming back for 2-3 transactions, which is fantastic. It's a lot easier once you get through the process the first time. It's a lot easier. Although interestingly enough, equity is taking us a lot less time than a commercial debt deal. Most of the time we're waiting on the debt on a transaction, which is why we're now offering the debt so that we can help to control the process and give our borrowers and sponsors more certainty of execution by providing both. But yeah, it's usually on equity raises, it can be as fast as 30 days or less, and then on the second one, it's even faster. So the raise itself is relatively quick.
So in terms of the process, it's basically someone gives you the underlying fundamentals of their investment, you vet it, and then you post it on Realty Mogul.
Yes.
And then individuals log in, or is there an announcement that there is now an opportunity
We
to
send
invest?
out an email blast to every member in our database. All of our accredited investors have a pre-existing relationship with us, which is required for Reg D offerings. So we have a cooling off period if you're new to the site. But all of our our investors will get notification that a new investment opportunity is available. They log in. We have a full diligence package. We do very thorough underwriting on all of our transactions and work with our sponsors to present the financials in a way that we're mutually agreed upon. But yes, every one of our transactions has been pre-vetted, and we work through a broker-dealer in order to maintain compliance on the sale of securities.
And then what does the long-term look like? Does the person stay in permanently in the investment, or is an exit of some sort?
Usually it's a 5-year hold. We've done as long as a 10-year hold, but there's usually an exit strategy. Although, to be fair to our sponsors, there's not a required exit. So if the market turns, it's one of the value adds of our capital as opposed to a fund where there's a close end to it, and it doesn't matter whether it's the wrong time in the market or not. My guess is that at some point there'll be a secondary that will allow our investors to sell off transactions, although that's on the long-term horizon. But for right now, they're completely illiquid, asset investments. We tell our investors that they're in for as long as the sponsor wants them to be into the transaction, that they are not able to get out until the sponsor sells. That said, depending on how much equity we've raised for the transaction, we might have a buy-sell provision, depending on our control rights that have been negotiated.
Have you been oversubscribed on any of these transactions?
Most of our hospitality deals are highly oversubscribed, so that's exciting. It shows that there's a huge amount of demand, particularly in hospitality, because it's a yieldy investment, because there's a little bit more excitement to those transactions. People like the story behind hospitality. They are sexy. Multifamily, it's not the hardest transaction to get into. It's really much harder for your armchair investors to get into a hotel deal.
Got it. How do you see the market changing and your platform changing? I mean, obviously we're at a low interest rate environment.
Yeah.
Just helping.
Yes, it's definitely helping, and I think that you're probably going to see additional cap rate compression. I think you're going to see rising interest rates. I think that the 20-plus IRR deals that most people are demanding and wanting are going to be dropping somewhat just by the nature of competition in the marketplace. There isn't that many good, solid real estate transactions, and we won't push yield just for the sake of pushing yield. We'll present to our investors what we think are sound investments that our sponsors are able to execute on. So we believe in our transactions. Nothing's guaranteed, of course.
Good
but
risk factor.
yeah, I know. Let me throw that in there.
Yeah,
nothing's guaranteed. Yeah, you can drop that footnote on any time I speak. But there is, I think, the appetite in the market, even just looking at the debt we provide, that there is so much capital out there in the marketplace that it's definitely compressing things all around.
Are you getting family office or institutional, or it's really...
Absolutely.
You are? Okay.
Absolutely. Our debt on our platform is highly institution focused, just by the nature of borrowers in the marketplace want lower rates, and they can get lower rates, and institutions are willing to take on those transactions with lower yield. So
we hope you have a greater focus on hospitality. So we look forward to having you in the marketplace
You bet.
as much
Thank
as
you.
possible. And congratulations on your success.
I appreciate it.
So
it's a pleasure to be here. Thank you.